Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace. Today I want to talk about collateral calls. A lot of people have written and phoned in asking us why it is that AIG has funneled so much taxpayer money to companies like Goldman Sachs and other banks because of their credit default swaps, their CDS. And the real reason is because of this collateral call issue, or that's certainly one very big reason. So let's address that a little bit. Test my spelling first by getting this up on the board. And I'm writing this up because, because it basically, this gives us a good idea of what the issue is. It's a phone call made about collateral, kind of like a margin call, quite similar to that. So, and it all centers around, as I said, the credit default swap. So let's look at our players. We have Sam here, okay, and Sam has got a $5 million chunk of General Motors bonds, okay, which he wants to insure. So he looks around and he finds AIG, and he decides AIG is the one to insure with. So here's our player at AIG, and we'll just call this guy AIG. There he is with the smile. Actually, he hasn't got a smile, has he? He's got a frown. Got dirt on his face. All right, here's AIG. Okay. So so Sam makes the call, and he says to AIG, look, the reason I want to insure this is if anything goes wrong with GM bonds, okay, I want you to pay me my $5 million. Okay, so say, for example, General Motors defaults, or General Motors goes into bankruptcy. Essentially, if General Motors stops paying the interest that it pays every month on its bond, okay, Sam says, I will give you the GM bond, and then you'll give me $5 million, okay, because the GM bond may be worth 20 cents on the dollar or whatever. But essentially, it means that Sam isn't going to be out his $5 million, so that's what the insurance is for. And the AIG says, okay, I'll do that. If something goes wrong with GM, I'll take the bond off your hands and I'll give you $5 million. But in return, I want a fee. Okay, and the fee is going to be, say, $500,000. Okay, so every year, say, Sam is paying $500 to AIG. So it kind of looks like a car insurance, right? If this was a car, you know, if you crash the car, you'd give the car to AIG, and AIG would give you the money back. But credit default swap is somewhat different, and one of the main differences is the whole issue of counterparty risk, and that's where this whole kind of payout comes. Because Sam is the two counterparties in this deal are Sam and AIG. Now Sam is worried about AIG, and he wants to hedge against counterparty risk. He wants to kind of insure himself against a risk that AIG, for some reason, may not be good for the $5 million. Okay? Say AIG has too many of these insurance contracts written and it hasn't got enough money, or its investments have gone bad and it hasn't got enough money and it can't pay that $5 million. Sam wants to insure against that. And one of the main ways he does this is by asking for collateral. Okay? So he writes into this contract, he says, okay, I want you to give me some collateral, okay, in this deal. I'm obviously paying you $500,000 a year, but the collateral I want for you to ensure that, you know, there is at least you're good for some of the money, is I want you to give me $1 million, okay? So he gets $1 million from AIG. AIG surrenders that $1 million to him. That's the collateral. Now, obviously, if the General Motors bond matures, then the deal unwinds because there's no need to insure this anymore, and the collateral will be returned. Okay, but what happens if AIG, the risk to AIG increases? Say, for example, now it's AAA. Obviously, I'm dreaming, but say, for example, it's AAA. And Standard & Poor's comes in and looks at AIG's books and says, there's no way, man, you've written way too many of these insurance contracts. The value of your portfolio is down. We're downgrading you to AA. Okay? This means that AIG is more risky. Now, Sam has written this contract very, very carefully with AIG, and it rings AIG up, and he rings AIG up and he says, hey, you guys have been downgraded. The risk to me is increased. This is your collateral call. I want you to give me another $1 million. Okay, says AIG. There's that $2 million. Okay, so that's how Sam hedges against his counterparty risk by increasing the collateral whenever the risk to him increases. But there's another side to this, which is the risk of the actual bond itself, of the underlying security. Because if General Motors is downgraded by Standard & Poor's, that means the risk that General Motors is not going to keep paying its insurance, the risk that General Motors is going to stop paying its interest payments every month increases. Now Sam looks at that and he says, okay, this is getting more risky. I'm also worried about AIG, so again, I want more collateral. So the other part of the engine is if General Motors' rating decreases, so say General Motors was BBB, and its rating decreases to, say, CCC, then Sam calls AIG and says, hey, this is now riskier. I'm worried about the risk to me. You need to surrender more collateral. So again, AIG says, okay, and comes up with another $1 million. And the whole point of this is that Sam is making sure that he gets as much upside as he can from this credit default swap, from this insurance contract. Because if AIG goes bust and can't pay, or it's got too many insurance contracts written and it can't pay, then at least he's got this $3 million in the bag. Now, the issue that's happened, and the reason that everyone's very excited about these right now, is because we're dealing with not AIG's money, but in many cases, Uncle Sam's money. Okay, here's good old Uncle Sam, all right, and he has channeled a vast amount of money, many billions of dollars, okay, into AIG. Okay, now what has happened is that as AIG's credit quality has deteriorated, as Standard & Poor's and Moody's and the other ratings agencies have downgraded it, and as the value of its investments have fallen, as the market has fallen, and as the quality of its, or as the extent of its exposure to the credit default swap market has become apparent, it means that the risk to the counterparties like Sam has increased, which means they are calling AIG, hundreds and hundreds of Sams are calling AIG and saying, hey, you have to surrender more collateral. You've been downgraded. The quality of the bonds we're insuring has deteriorated. Therefore, you have to surrender more collateral. So vast amounts of this money is flowing through AIG and into places like Sam or Goldman Sachs or whatever that bank may be. Okay, and this is what everyone's got very excited. We're calling it a backdoor bailout and other things. But essentially, this is the consequence of the contracts that AIG has written with its counterparties. It agreed that if it was downgraded or the risk to its counterparty or the risks to its counterparties increased, then it would surrender more collateral, and that's what's happening. These collateral calls are coming thick and fast. The money's piling, the taxpayer money is piling through AIG, through the system, and into the accounts of companies like Goldman Sachs, and that's obviously leaving the AIG and the taxpayer, frankly, very badly, needing a drink.